Okay, I think we will start off with the webinar, and I'm sure there'll be one or two people who kind of join us as we go throughout. So welcome today, everybody. We'll be talking about the Portuguese investment bond. I'm Matt Penfold, Paul Correa here as well. We're both from Fiduciary Wealth. And I won't go for the long introduction. You'll learn more about us as we go through, but I think it would be useful to direct you to our website, fiduciarywealth.gi. You're welcome to go review our independent reviews on Trustpilot, and definitely we would urge people to go to our YouTube channel. So there's this webinar, our weekly podcast, the Money and Finance for Expats, which you can see on our header, which we discuss Wednesday every week. And we discuss everything and everything related to finance for expats. So if you visit our YouTube channel, please subscribe, like, and share with your fellow expats and friends and family. And we want to add a lot of value out there amongst the expat community. So yeah, subscribe and you can join our weekly podcast community. So today we're talking about the Portuguese investment bonds. Let me bring that down. And so firstly, I'm going to run through a few technical details, what it is, how this works. But then I will pass to Paul. And really the main reason we're running today's webinar is we're launching a new market leading offer for the Portuguese bond. A lot of value at a lower cost. I know Paul's very excited to tell you all about this, so I won't spoil it too much ahead of the time. But yeah, we'll get to that. But we'll start the webinar in a minute. The last thing I'll add is there's question and answers. You could submit those via the Zoom. Feel free to fire your questions at us, and we will answer those as we reach the end of the webinar. So yeah, let's get started on the
Can I just interject, Matt?
Very
quickly.
Yeah.
We're doing this webinar on the Portuguese bond. So what I'm going to say might shock a few people and surprise them. But I think it's important that we send the message loud and clear that we're not in love with the product. You know, we're not here trying to promote the Portuguese bond as if that is the solution for every single client and every single situation, because it's not. And for us, we don't focus on the process and on the product. The most important thing is that the client gets, enjoys the experience and gets the result and the outcome that they need to fulfill their financial goals and aspirations. So it's all about serving and embedding value to the client rather than the product. So the fact that we're promoting the product doesn't mean that we are promoting it to every single client, or that it's relevant to every single client. And I want to make that statement clear, because it's quite unusual that we do product-specific webinars, because you don't know, we need to speak to the client, establish what their pain points are, their fears, their worries, and at the same time, what are their goals? And only after you've gone through a process of understanding needs and wants can you really advise on a product. So this is just putting the information out there, but it's not a promotional webinar on the Spanish bond. It shouldn't, only for those clients that think that this is the right product for them.
Perfect.
Yeah, if it makes sense.
No. Well, it does to me, hopefully to our viewers as well, Paul. But exactly that. The Portuguese bond might be the perfect product for one person and totally unsuitable for the next. And it's not our position here to say as a general conversation to everyone it's suitable for you. It may be, but we'll give you the information here, and if you think it might suit your situation, or you may just want to talk about your overall financial planning, reach out to us and we can look at that for you. So the Portuguese investment bond, so what is it? Officially, it's a single premium investment linked assurance policy that meets a number of conditions that mean it's deemed to be tax compliant in Portugal. So that's the official description. what actually is it? So the Portuguese investment bond is a wrapper around a portfolio of assets that you hold, and the bond itself, the tax wrapper, comes with it quite a lot of advantages to those that are Portuguese residents. So in the UK, we're used to things like the ISAs, maybe UK bonds, similar investments structures. The Portuguese bond is the closest alternative here, and in Portugal, like some European countries, the financial services is very different to the UK. There's very few products. People just tend to keep their money in the bank. So the Portuguese investment bond was actually created for expats and is only available for expats in Portugal. And it was created in such a way to make it compliant, so it has these advantages for people who use it. So really, we talk about single premium policy. So it's usually set up and invested via a lump sum. You can make additional contributions to it, but there is a minimum. I think the minimum is 20,000 euros for each contribution. And as I say, the bond acts a wrapper around the assets. And a key part of it, and I'm going to get onto the key features and benefits now, is that there is no tax. So until you make a withdrawal. So a lot of people are resident in Portugal under the NHR scheme, and there's a lot of tax benefits to the NHR scheme. But one of those tax benefits, one of the things that is it's, I don't know if they missed it, Paul, or if it was they left it out, but capital gains. Capital gains is very high in Portugal, 28%, and there's no discount for NHR. So if you want to have your investment portfolio, maybe you had one in the UK before, you've got a large sum of money that you wish to invest, and where that came from, we can cover that shortly, then this may be suitable for you. So the key benefits. So you defer any capital gains during the accumulation phase of the bond. So what we mean by that is there's no tax charge unless you make a withdrawal or a surrender from the bond. Then when you do make a withdrawal or surrender from the bond, that tax treatment is, well, there's two parts of it. A, only the growth element of the withdrawal is taxed. And B, the longer you hold the assets within the bond, the lower the tax rate. This reduces down. So I have a visual demonstration of this, if I can just share this with everyone. So here are the tax rates in Portugal, if you can see it on that table. So when you hold the policy, the taxable income in the first 5 years is taxed at the standard 28%. In years between years 5 and 8, this goes down to 22.4%. And then year 8 onwards, it's 11.2%. So that's the effective rate. And the way that works out is the amount of that growth that's taxable reduces over time. So it's 100% of it in those first 5 years, then 80%, and then down to 40%. And that's where you get the effective rate of 11.2. And then, so when you come to make a withdrawal, and we've got a demonstration there, as we say, the amount that you pay on the tax is just based on the growth element of the bond. So using this fairly simple example, somebody invests a relatively modest amount, 100,000 euros. They've had 8 years of growth, 50% growth. So it's now worth 150,000 euros. So you've got the capital, 100,000 euros, and the gain of 50,000 euros. So 2/3 of that is the capital, 1/3 is the gain. This individual wants to take a surrender, in this example, 15,000 euros. So 2/3 of that, 10,000, is return of capital, no tax on that. 1/3 of that is 5,000 euros in this example, is the gain, which is taxed. Now, based on the tax rates, which was demonstrated on the previous slide, because they've held it for 8 years or more, it's just 11.2% tax on there rather than the 28%. So the tax paid is a mere €560 or an effective tax rate of 3.73. So I just leave that up for a couple of minutes so you can see how that works out. And a part of that as well with the tax is the tax is withheld. So the bond provider actually pays this to the tax authorities for you. So you just receive the net amount. So from a kind of purely admin point of view, that works in your favor as well. There's other benefits to you using the Portuguese compliant bond as well. So it can be set up in joint names. And when the first person passes, this can be, the bond can continue in the second spouse's or surviving spouse's name. Any death benefits, as long as to your beneficiaries. I mean, there's not really succession tax in Portugal anymore, but this would fall out of scope of Portuguese stamp duty. And if you were to return to the UK, and this is something that we'll cover a little bit later, it's possible that this can be portable and converted back to a UK bond. And another benefit is from a reporting point of view. We talk about how the payment is paid directly to the tax authorities. So there's no calculating each year your capital gains, your dividends, your interest, or things like that. It's a very, very simple structure that's not only kind of tax efficient, but from the management of it is very efficient for you as well. So we talked about when a Portuguese compliant bond may be used. And one such occasion, you've relocated from the UK, you've got a lump sum, maybe from your sale of your investment portfolio, some property in the UK, and you can invest that in the Portuguese bond. But one use that's maybe lesser known is when you come to sell your property, the people sell their property in Portugal. So again, in the UK, we're used to, you've got your main resident, as long as you're living in that, you sell that, and there's no capital gains on it. In Portugal, that's not quite the case. If you sell your property and reinvest it in a property of equal or greater value, then there's no capital gains. But if you sell your property and you decide not to reinvest that in a property, you decide to rent, or you decide to buy a property of a lower amount as we get older, this is often the case, we move to a smaller property, then the excess is potentially subject to capital gains in Portugal. Now, one way that can be mitigated is if you reinvest that sum into a qualifying investment, and the Portuguese investment bond is such qualifying investment, then again, it avoids a capital gains taxation on that amount. So for those, potentially downgrading their property or selling their property, they may want to kind of rent or something like that. Then the Portuguese investment bond is a way to kind of manage their taxation from that point of view as well. So that's the bonds in a bit of a nutshell. It can solve numerous issues, as I've said. There's another point in the sense that bonds can be held in a choice of currency, sterling, euro, USD. Generally, we would expect that to be in line with your base currency, which tends to be the currency that you earn or spend money in, which, given that this bond is aimed at residents in Portugal, we'd expect that to be euro. So it's nice to have the investment or all investments in euros if you're spending in euro, and then you're eliminating any currency risk. So that's really what the bond is. And that's a few details about the bond, but that's not what we're here for today, really. The main purpose of this webinar is to launch our new offer, because we're not tied to the bond. We're not the only ones who are able to provide this bond to clients. But what we want to do is give value back to the clients. And so we're launching a relaunch of this product from ourselves. And Paul, I know you're very excited to tell people about this. So may I hand over the reins and you can add some meat onto that, what I'm talking about?
Absolutely. Thank you, Matt. Well, as you know, we're very passionate about positively shaping the wealth of the British expatriate community through tax-led wealth management advice. And, you know, our mission is really to help and improve the lives of the British expatriate community in the Iberian Peninsula, whether that's Gibraltar, Spain, or Portugal. And yeah, and we're incredibly proud and privileged to serve the British community. Matt, as you know, we're not a financial supermarket. We're not churning out products off the shelf just to push it through to anyone and that comes our way. Our advice has always been impartial, holistic, and individually tailored. We treat each client as individuals, and we are perfectly attuned to their every needs and wants. And that's why I made the caveat at the beginning of the webinar that, notwithstanding the fact that we were addressing, you know, listeners who had a specific interest on the Spanish bond, that we're not in love with the product. And, you know, even if we approach about the Spanish bond, we would have a more, I'm going to say, a broader conversation to make sure that it was the right fit for the clients. So we started this process, Matt, looking at the Portuguese bond introspectively, looking at the client's needs and then working our way backwards. And as you know, we put every ounce of energy into creating a whole solution rather than a customized product which is off the shelf, because we care deeply about the clients that we serve, and we honestly believe we can provide so much more value. I think the British community in Portugal really deserves that we can go out there and provide some help and offer not just the one solution. Yeah, I always say, if all roads lead to Rome, to the Portuguese bond, then the advisor is not doing his job, right? So I repeat that. But look, what we're offering is a premium product, a massively improved version of the Portuguese bond, because it's a commodity, Matt. The Portuguese bond has embedded tax benefits, which are great. I'm not disputing that. But it's not just, you know, the Portuguese bond in isolation is not the solution to all evils, yeah? It's just one structure that could mitigate tax and provide certain benefits in Portugal. So rather than treat it as a product on its own, and which is a commodity really, we've thought long and hard how we could integrate key additional benefits to create a superior product, which is recognizably better than anything else in the marketplace. I think, in a nutshell, that is what we've tried to do. And we want to do it in a very concrete way. I think the British community will welcome that, because they're going to learn much more about what their overall financial situation and requirements are. I always say, you know, that clients have some trigger points, yeah? They've got, you know, pains, worries, and fears that we need to address, but equally, they've got financial goals, aspirations, and dreams that we need to fulfill. And it's only by engaging with them and understanding what the pains are and what the goals are that we can structure their financial affairs more tax efficiently. You know, we know that we have to defend the wealth from an overzealous taxman, whether that's in the UK or Portugal. But look, from experience, Brits that have moved to Portugal have three basic needs, and they're quite basic. The first one, which we come across all the time, is how can I sustain my lifestyle in retirement? They've worked all their lives. They have this big, fantastic dream of life in Portugal. Do I have a, you know, do my pensions, savings, and investment, the whole pot, is it large enough to sustain the lifestyle that I want to lead in warmer climes. So that's the first and most basic need. The second one is if the pot is large enough to sustain the lifestyle in retirement, will there be anything remaining? Yeah. Is there anything left after I have passed away that I can preserve and transfer to my heirs, to my children or whatever? Yeah. What is the residual value of my estate once I've passed away? I've had this fantastic life, and there's some assets I want to pass on to my spouse or to my children. So those are the first two basic needs in that priority. And then thirdly, very often, Matt, you may have come across a few cases too. People think, okay, yes, I want to sustain my lifestyle. Yes, I want to transfer my wealth to my heirs. But do I have sufficient financial resources to cover my end of life care needs? Should I go back to UK? So in essence, those are the three things. And when we think about, before we think about the product, we need to think how we can fulfill those basic needs. And I'm happy to take questions at the very end from listeners if their understanding is completely different and their basic needs deviate from these three. But in our experience, Matt, from all the cases we've had, pretty much those are three things that come to mind. Of course, sheltering tax and mitigating tax goes without saying, but in the essence, the goals are those three. So we've aptly termed the Portuguese bond the Alpha Star Collection, because alpha in financial markets means providing a return over and above what the stock market gives. And because we want to give significantly more value by bundling additional services around the Portuguese bond and also at a discounted price, we called it alpha. And yes, it's true. It's more for less. It might sound too true to be true, but it's actually true. We're also trying to eliminate the complexity to make the product simpler and easier to use whilst reducing the establishment fee by half. So we already, before we made this offer, Matt, we're already the cheapest in the market, if not one of the cheapest. And this is actually an insane offer, which is currently unmatched in the marketplace. And we're doing it basically because we do care about the clients we serve. So let me tell you a bit about the standard price in the market, because this is the interesting bit. If you search around, you'll find some IFA practices who promise you the earth. They'll say no establishment fees. But as you know, everyone knows there's no such thing as a free lunch, right? You may have been sold that story that it's free, but everyone knows that it can't work like that. We're talking about companies, they have staff, they're providing services. There must be a cost. And very often what they do, Matt, is they establish a Portuguese bond with an early encashment period of up to 7 years. So what are the implications and what does that mean, early encashment? Because for the average punt out there who's considering a Portuguese bond, it might mean nothing. But let's try to explain it in layman's terms so it's readily understood by the listeners. So the IFA uses the early encashment mechanism to take the maximum available commission payment under the terms of the bond, which in some cases could be as much as 7%, but in other extreme cases, they could take as much as 10%. Yeah, think about this, Matt. You put £1 million, and the IFA is already making 100,000, between 70,000 and 100, using this early encashment mechanism, because someone has to pay for this. And let me explain how this works. The IFA gets paid the commission up front by the bond provider, which for the Portuguese bond is Atmost. So Atmost goes, thank you for selling this bond. Here's 7%, for argument's sake, upfront. But of course, Atmost are not going to pay the IFA immediately and carry the cost of that establishment fee. And the establishment fees has to be paid by the client. So what happens is when you tick on the box early encashment 7 years, is that then you're authorizing Atmost to recover the payment they've paid the IFA practice in advance. So you say, thank you, IFA, here's your 7%, but now I'm going to collect it from the client over 7 years. And they start deducting those charges over the 7-year early encashment period. So the IFA is not out of pocket. They've got the money immediately. They can run away and look for another vulnerable client. At most, have paid them, but they're recovering it from you. And because it is subject to the early encashment period, it means that if someone were to surrender their policy during those 7 years, then any outstanding charges, in other words, commissions paid to the IFA, can be deducted from the surrender value. So basically, it's the client that is paying for those 7%. So let me explain again. You actually, when you tick the box, early encashment charges 7 years, you're indemnifying the IFA who walks away with a large commission payment, and you're left to pay the bill. It's quite clever, Matt, isn't it?
It is, and I've got another problem with this, which you're paying the advisor up front. Okay, they've got their money nicely hidden as well, which I think is very sneaky. And they're thinking, well, what's my motivation now? I've got this large sum of money. What am I going to do? Service this client who's paying me for the next 7 years, although I've already been paid? Or shall I move on to the next guy? I think we all know the answer to that one, don't we? So yeah, it's a clever system, but one that we just don't agree with at all.
But I agree with you entirely, Matt. The problem is that because there's no ongoing engagement or no means to get more income out of the client, then they have to look at sneaky ways of making income. They try and sell you structured products. They can't do it in every bond, right? The Portuguese bond probably excludes it, but they look at other ways of trying to generate income. And, it's not a win-win. Business is a spiritual game. Everyone needs to make money and profit. It's understood, but you have to disclose the fees. I mean, the UK now, there's the Consumer Act, the Consumer Duty, that you really have to act in the best interest of the client. So unfortunately, in the expatriate space, it doesn't always work like that. And look, I think a lot of clients in Portugal and Spain, and perhaps more in Spain, there's an issue of trust with IFA, with financial advisory practices, because of their past history. And, even though it's getting better, they're still trying to make too much money from the client. Now, Matt, to be fair, not all firms are the same. And some will charge an explicit establishment fee, like most firms, IFA firms in the UK, right? It's only fair for me to say that. But it's still not uncommon for the establishment fee to be 3% or higher, and sometimes lower if it's a larger amount. But 2 is not unusual. It's probably 80-90% of the cases, if not more. And so what is our price offer? We could establish the bond for just 1%, but it's payable in advance. So if you invest $1 million, you pay the 1%, which is 10,000 in advance, and then when the bond is finally open, it's done at 0, because our fees are explicit. So we cut the price by 6-7%, best case by 2 or 3. For the firms that are charging now 2 or 3, we'll cut it down to 1. But we don't want to sell a product, because the value is not just on the product. It's about providing holistic, impartial, and individually tailored advice. So, so basically what we do is we try and see what other value can we add to the client. And our focus is on precisely on that, adding value. So on the one hand, we're discounting the price, but at the same time, we're offering additional and quite substantial added value. So we're using specialized resources within the firm to integrate some key benefits and deliver a vastly superior product. So what are the added value services that we have embedded into the Portuguese bond? Well, we produce a cash flow analysis to begin with, to ensure that the individual, we said one of the basic needs was to ensure that they had sufficient capital to sustain their lifestyle in retirement. So we do cash flow simulation exercises, looking at the best case, base case, which is what anyone expects, and a worst case. And we look at tax rates. We look at rate of return on the investment. We look at inflation rate. We look at the amount of withdrawal they want to make. And then we can tell them, on the best case, your money will last you 25 years based on these assumptions. The assumptions can be wrong, or the assumptions can change over time. And you might make special withdrawals to go on a cruise or whatever. So at least we give them some direction, say best case, base case, worst case, it runs in 20 years. And maybe the advice is you can't draw 60,000 a year. Really, for the amount of pension savings and investments that you have, you should be drawing less than that. Or on the other hand, no children, no heirs, and they just want to draw 40,000 when in fact they could draw 80,000. We say, look, it's up to you how much you spend, but you've got enough there to be able to draw much more than you're currently drawing. So those are the kinds of conversations. So we do the cash flow analysis simulation, which adds considerable value. We then help the client plan an orderly UK exit from a tax perspective. And that includes assessing the UK statutory residency test and the number of ties that you have in the UK. So one, from an exiting point of view, what ties you have, and two, from a returning point of view, meaning you exit the UK, you go to Portugal, and very often when we engage in conversation, we have people saying, no, I want to spend 120 days in Portugal, the rest 240 in the UK, but I want to be Portuguese tax resident under the non-habitual residence region. Well, it doesn't work. And you know, based on your personal, you know, your business, social connections, property and so on, determines how many days can you trip back and the ties you have without re-triggering UK residency. So we do that little exercise because we generally believe that that adds a lot of value. And then, of course, we review the UK domicile status. There's no Portuguese succession tax between descendants, yeah, first line and so on. So you avoid that to a certain extent. But because you're UK domiciled, and you know, and there's a double taxation treaty between the UK and Portugal, but the UK taxes people based on their domicile status, which is where you're born and where your father's born. And quite often you have a potential liability to UK inheritance tax, regardless of where you live now. So part of the advice is, how do you mitigate tax with regards to your UK inheritance? No Portuguese succession tax, fantastic. But don't forget that in the UK, it's not based on where you're tax resident, but on your domicile, where you were born and your father. So we look at that piece and we structure it with that in mind. Then we deliver a very comprehensive pre-arrival or just arrived tax planning strategy report, which covers all the key areas and all the relevant areas regarding your tax, financial, and retirement planning issues. Again, a lot of value there. Normally, these services are priced separately and they're worth a lot of money. And then we also look at the advice if you know, if the individual matters looking to dispose of their UK main residence and use the proceeds to buy a home in Portugal. We advise, or sometimes they have the main residence in the UK, which they want to dispose of because they want to make use of the capital to sustain that lifestyle, but they haven't quite made up their mind when to dispose of the UK property. We give very detailed advice on the timing of the sale of the UK main residence to secure, if possible, capital gains tax exemptions, because those exemptions get diluted. You say, but there's no tax in the UK for disposing of your main residence. Yes, but you're not tax resident in the UK once you've left. And those exemptions get diluted after 9 months. So you have a little window of when to dispose of UK property. Again, why? Because we can save money and add value. And then, of course, we give people access to a personal finance portal. They can access from any device, anywhere in the world, and at whatever time, 24/7, they can put all the assets there and store the information, bank account details. They could put UK properties, and it's linked to Supla and gives you the value of that property based on the residential address, because it's synced in with Supla. So you've got up-to-date net worth statements and a lot more. So we give that app, and you can access the app. I mean, the minimum investment is £250,000 to be given a heavily discounted price and all the added value benefits I've just mentioned. But if it's less than 250, look, the price will be higher, but not significantly high. We'll try and be extremely competitive. Look, this puts a lot of strain on the business. Matt, you know it, I know it. I think you don't necessarily agree that this is the right thing to do. You've got your concerns, but I think genuinely and truthfully, I think it does add considerable value. And you know that we care. We are passionate about serving the British expatriate community in Portugal. And, you know, our business, I always say that is a spiritual game. Business is a spiritual game. And you know, we are here for the long haul. We're here to give as much value as we possibly can, make sure we get a positive outcome for the client, make sure we embed value, and the client can then focus on enjoying their retirement. And if I may just end, because we're a bit quirky in that, firstly, we're born out of a law firm, the oldest law firm in Gibraltar, founded in 1892. So there's a long history. We've been in business since 2007. We've got an impeccable reputation in the marketplace in Spain and Portugal. We also happen to be members of an accountancy network, which has its origins in Weybridge in Surrey in the UK, and has today mushroomed into a global accountancy network. And this morning on LinkedIn, I saw a post that said that MGI, and we are the Gibraltar MGI firm or representative firm, is the 17th largest global accountancy network. So we've got legal roots, we've got accountancy roots, and we have financial advisory practice with a difference. And the big difference is that not all roads lead to Rome. And we don't love the Portuguese bond more than any other product. You know, even if we engage with someone approaching us on the Portuguese bond, we might conclude that that is not the way forward. It doesn't really matter to us how we structure it, because, and if I may add, and if we engage with a client and the Portuguese bond is part of the solution, or not even the solution, we would still provide the same pricing, because, as I said, it's having raving clients that feel that they've got good value for money, and they are keen to engage in a mutually beneficial relationship, and hopefully they are the ones spreading the word of mouth. So that's who we are in a nutshell.
Perfect. Thank you, Paul. And you mentioned my feelings on this offer earlier, Paul. We call it the Alpha Star offer, but as you know, I call it the Madness offer, because we wanted to make this offer and we want to deliver this to the expat community. And I remember we spoke about this and we talked about lowering the cost, should we add extra value? And what we've done is gone for both of them. So it's legitimate as we're saying this. It's we know of nothing in the market that's even close to this. So that's what we're looking to offer. And that's unrelated to the bond, as you say. That's what we're looking to offer, regardless of this is the right product for you or something else is. Which kind of takes me to the next point. And we sometimes get asked, okay, but there must be circumstances where you shouldn't use the Portuguese bond. And yes, there are. And there's a few obvious ones. And again, these are things that we've seen in the past and in Portugal and Spain. I think, as you say, Paul, more so in Spain, but in Portugal as well, which is very frustrating for us. So if anybody ever suggests you have a bond within a pension, be it the Portuguese bond or a general European executive bond or whatever way they dress it up, If they suggest putting the bond in your pension, be it your QOPS or a QNOPS, or even if they can attempt to do it in a SIP, anybody suggests to do, not only you should say no to that suggestion, say no to that advisor stroke firm, because the only reason they would be looking to do that is so they can do what Paul you were explaining earlier, is they can take that high commission upfront out of the bond, which the pension provider wouldn't allow, but the bond provider does. Is the only reason. And why would someone have a pension and a bond combined? You might want them both as separate, but definitely not combined.
But Matt, if I may just interject, and you're absolutely right, and if I may expand on that point, we had a case last week, as you know, Matt, of a client interested in moving to Portugal, and he had advice from another firm, and the advice was, let's forget about the bond embedded in the pension, which is bad enough, yeah, and the fact that you could go back to the UK and the income would be treated as a UK bond rather than as a pension. But the advice that the bond should be owned by a pension, and the pension was based in Guernsey. Guernsey is, that anyone that knows, is blacklisted by Portugal. So blacklisted countries, you can't really have structure things tax efficiently using a pension trustee in a country which is blacklisted by Portugal. That doesn't make any sense. It doesn't offer any tax benefits. It just creates issues for the underlying client. So that is the kind of advice that really concerns us, and would really make a big effort to try and educate clients and give them as much information as we can to understand the traps that are being placed before them and the consequences of bad advice. And unfortunately, it happens all the time.
No, it's very true. It's still out there, as this case explains. I mean, it's almost frightening to us, but I think the frustration from my point of view is that, you know, people come to an advisor for their advice, and there's trust in that person's giving them the best advice, and unfortunately we don't always see that. So that's one situation. Another situation is exactly what we covered before and linked into that. The bond can be set up on a commission structure or a fee-based structure. The bond provider allows either. It should always be on a fee structure. The commission is hidden commissions. You don't know what you're paying. You're more than likely paying more, and it's not for your benefit. In the UK, they banned commission because of this very reason. In the expat space, that's not the case, but it needs to be set up on a fee basis. And another situation I get asked occasionally is somebody looking to use the bond for a very short-term investment. I give an example. Someone's got a sum of money. They're recently in Portugal, so they're thinking, we're going to rent for a year and then we're going to buy. But we don't want to leave our money in the banks. Is it safe there? Or we get a great interest rate? Let us invest it in one of these bonds for a year. Now, firstly, that doesn't really take advantage of the tax benefits of the bond. But secondly, the underlying funds are invested, and we're perfectly honest, you know, the markets go up and down, and having a time frame of just a year when you need that money without fail in a year isn't enough. So it's not a short-term product, and it should be avoided in that case. But Paul, you have a couple of questions for me, is that right?
Yeah, I just want to put you on the spot and try and be awkward as always.
Yeah, your favorite part of the day, I believe you call it. Yeah,
exactly.
Yeah.
So my question is very simple. How long should you keep the Portuguese bond for?
Okay. I mean, there isn't an exact answer to this, but we saw earlier the demonstration of how the tax goes down after 5 and 8 years. Ideally, it should be held, and you should be looking to make any withdrawals from 8 years plus. That's when it really kicks in the tax efficient. It can be held for a shorter period than that, but then it's not making the most of the benefits on that. What we would say is, you know, again, go back to what we said, the bond shouldn't be tied in. You should always have the option to unwind the bond if there's an emergency or whatever. So you should never be tied in. But in reality, when you go into the bond, you should be looking for a time scale of up to 8 years plus.
Fantastic. And I have two more questions. One which I hear all the time. It kind of makes sense because people always have, what if I return to the UK? So my question would be, what happens if an individual establishes a Portuguese bond with intention of staying for the 10 years of NHR and possibly beyond, but then 7 years in, health, whatever, death of a spouse, change in their personal life, they want to go back.
Yeah, no,
What happens then?
we see it a lot, and sometimes people plan to go back to the UK for whatever reason, one that I can't understand, to be honest. Sometimes, as you say, circumstances change and they return. So the bond is what they call portable. So comes from the bond provider, what most of them sold. So it can be converted to a UK bond. Now, the caveats with that is that it needs to be done properly. It is a technical product, and there's certain conditions that need to be met to ensure it's going to be converted to a UK bond. Ideally, if somebody's planning to return to the UK, then when the bond is originally set up, that can be factored into the conditions of the bond. But if circumstances change at a later date, it can be what they call endorsed to make it UK compliant. But it's important to go through the process properly and have someone alongside yourself who can make that happen for you.
Okay. And quickly, can the bond be held in joint names?
Yes, it can. Yep, and it's something that often we recommend. Bond goes in joint names, and if something was to happen to one of the individuals, then the other party, generally the spouse, they can continue with the bond. It doesn't need resetting up. So if we talk about the time period with the tax advantages, we're not restarting the clock. The bond can continue. So it makes sense in most cases to hold it in joint names.
Okay.
I'm done, Paul. You let me escape?
Yes.
Oh,
It's all
perfect. So,
done.
well, in response, and this is a very nice one for you.
Okay.
One question. What is one piece of advice you would give anyone who's thinking about using a Portuguese compliant bond?
Well, the one piece of advice I would give is, if they are in an office speaking to a financial advisor and it's their first conversation, the second or the third, and after having engaged in a discussion and understanding, the fears, the pains, and the financial goals and aspirations, and at the end of the conversation, all they can offer you is this Portuguese bond, then I would be very wary, because the issue is whether all along, before the individual, the prospect, uttered the word, whether they always had that in mind. And surely it can't be one size fits all, right? Everyone has different needs and requirements, and the situation varies, and you have to be adept and flexible to be able to accommodate and consider from every conceivable angle what the situation is and how to mitigate tax and structure it. So if the conversation ends with, I've got the solution for you, it's a Portuguese bond, and that's all they offer, that for me would be a red flag. That's the advice I would give. Immediately you would say, you know what, I would get a second opinion, because I'd like to hear from someone that is truly independent and can offer, something else, or can offer, or can explain what the nuances are, and whether this is the, maybe after engaging with an advisor, maybe the conclusion is it is. But if the first thing they say is the Portuguese bond, then are they really giving true independent advice?
Good answer, Paul. I find it almost ironic, actually, that in a webinar where we're talking about the Portuguese bond,
I know.
Our advice is, be careful if somebody says to you, here is a Portuguese bond, but
Absolutely, but
it's completely honest. And yeah, you're right. I think one size doesn't fit all. So that's good. Okay, we've reached the end of the webinar, but I'm afraid it's not the end. Yeah, we've got 3 questions, Paul. So
yeah, the only thing is, I'm due to leave in about 5-6 minutes. If we can be sorry for the.
No. We can get through them. 2 of them from one person. They're from Robin. Thank you, and thanks for joining us, Robin. So it's about the bond and how the bond can save capital gains tax on the sale of the Portuguese property if you're over 65. And what Robin's followed up, if there are any age restrictions on this, is the age 65. Now, it's something I covered earlier, so I'm happy to answer this one. It's a good question. And there's a few more technical details that, Robin, I'll reach out to you directly and tell you about these. But it's not just 65. The direction is you must be either retired or at least 65. There are other conditions because basically they don't want somebody to buy the bond using the sale of the property, save their capital gains, and then just unwind the bond afterwards. So there's certain conditions with that. But yes, investing on the bond via the sale of your Portuguese property and saving capital gains is definitely possible. Robin, I'll send you some details. Anyone else want some details on that? Feel free to reach out to us. And this is quite a quick one. I know you know the answer to this one, Paul, from R Fox. Can you transfer an existing portfolio of shares in ETF to the bond? Can you self-manage the bond going forward?
No, you can't self-manage bond. You have to have an appointed financial advisor. And can you transfer an existing UK island domicile shares and ETF portfolio to the bond? I mean, the answer to that, I believe they have to be UCITS funds, and they're very strict as to what kind of instruments you can hold. So no, you have to appoint an advisor, and two, you can't hold just anything in the bond because it would disqualify the bond and the tax benefits that they provide.
Exactly.
So I'm afraid that the answer is no to both.
Yeah, perfect. Wonderful.
Yeah.
No, perfect. Yeah, you're right. You can't hold individual equities. Some ETFs, if they're UCITS, could be held. But yeah, the funds within the bond need to be UCITS to make it qualify. So yeah, that leads us nicely to the end of the webinar. So thank you so much for everyone who's joined us. Here I've just brought on the screen our contact details for anyone who wants to get in touch. Feel free to give us an email, call, please visit our website. And we're mentioning again our YouTube channel. We're building up more and more content on that every week. We've got our weekly Money and Finance for Expats podcast every Wednesday without fail. We're running more webinars. There's past webinars on our YouTube channel. So all completely free. We just ask that you subscribe and then like this and share it with your friends from the expat community. And I'm sure there's some really useful information that you can get on that. So yeah, I think that was great. Paul, any last thoughts?
No, I think, thank all the listeners that have tuned in today, because I hope we've managed to clarify some points and give some value back. So
Perfect.
It's always our mission to give value to our listeners.
Exactly. Wonderful. Well, yeah, thank you so much for everyone who's joined us today, either live or watching this recording. Please feel free to reach out for us if you want to discuss your financial planning as an expat. And I'm sure we'll speak to some of you soon. So
thank you.
Goodbye. Thank you.
Bye.